Today, we're going to be talking about how to avoid some common mistakes after applying for a mortgage. If you're getting ready to buy a home, I know it's exciting to jump ahead a few steps and think about moving in and making it your own. But before you get too far down that emotional path, there are some key things to keep in mind after you apply for your mortgage before you close. First, don't deposit large sums of cash. Lenders need to show the source of your money, and cash isn't easily traceable. Before you deposit any cash into your accounts, discuss the proper way to document your transaction with your loan officer. Next, don't make any large purchases. It's not just home related purchases that can disqualify you from your home loan. People with new debt have a higher debt to income ratio. This is how much debt you have compared to your monthly income. Since higher ratios make for riskier loans, borrowers may no longer qualify for their mortgage. Resist the temptation to make large purchases, even for furniture or appliances. There'll be plenty of time for that after the transaction is closed. This next one may seem obvious, but don't co-sign loans for anyone. When you co-sign for a loan, you're making yourself accountable for the loan's success and repayment. With that obligation comes a higher debt to income ratio. Even if you promise you won't be the one making the payments, your lender's going to have to count them against you. Just don't do it. Stop. This other one may not be as obvious, but don't switch bank accounts. Lenders need to source and track your assets. That task is much easier to do when there's consistency among your accounts. Before you transfer any money, speak with your loan officer. Next is don't apply for new credit. Doesn't matter if it's a new credit card or a new car. When your credit report is run by organizations in multiple financial channels, mortgage, credit card, auto, etc., it will have an impact on your FICO score. Lower credit scores can determine your interest rate and possibly even your eligibility for approval. So our last don't is don't close any accounts. Many buyers believe that having less available credit makes them less risky and more likely to get approved. This isn't true. A major component of your score is your length and depth of credit history, as opposed to your payment history, and your total usage of credit as a percentage of available credit. Closing accounts has a negative impact on both of those parts of your score. Up till now, we've talked about a lot of don'ts, but this is a very important do. Do discuss changes with your lender. Be upfront about any changes that occur or you expect to occur when talking with your lender. Blips in income, assets, or credit should be reviewed and executed in a way that ensures that your home loan can still be approved. If your job or employment status has changed recently, share that with your lender as well. Ultimately, it's best to fully disclose and discuss your intentions with your loan officer before you do anything financial in nature. Bottom line, you want your home purchase to go as smoothly as possible. There's two things you can do. One, before you make any large purchases, move your money around, or make major life changes, be sure to consult your lender. Number two, give me a call. Here's my contact info.